Hello everyone, welcome to Brilliant Bankers. In this session, we will be discussing about the second paper in JAIIB, that is Principles and Practices of Banking. So we will be continuing with or starting off with Module A, that is General Banking. We'll be having 50 MCQs in this session. And I hope everyone is having a good mark in the Indian economy and Indian financial system paper. If you are even having marks above 45, you can put extra effort in PPB so that you can easily score above 60 in this. So let's start off with the first question. A financial institution applies for a banking license, but it proposes to accept deposits only from directors and lend only to group companies. Which condition of banking under the BR Act 1949 is not satisfied as per this dialogue? Is it A, the maintenance of CRR with RBI, the acceptance of deposits from the public, maintenance of minimum capital and reserves, or obtaining certificate of commencement of business? What is it? So as per the definition, as per Section 5B of the Banking Regulation Act, banking means accepting deposits of money from public for the purpose of lending or investment. The word public is crucial. If deposits are only taken from internal stakeholders, it fails to meet the statutory definition of from the BR Act. So RBI's licensing conditions require that banks serve the public interest and not a closed group. So the right answer will be acceptance of deposits from the public. Coming to question number 2. When a customer deposits rupees 5 lakh in a savings account, the bank becomes in this condition, what is a relation? The bank is a debtor to the customer. Once deposited, the ownership of the money transfers to the bank. The bank owes an equivalent amount back to the customer. Hence, it's create a debtor-creditor relationship between the bank and the customer. The customer is the creditor and the bank is a debtor. Coming to question number 3. A customer authorizes another person to operate his account by giving a signed letter. This authority is known as what? Is it a mandate? Is it a power of attorney? Is it a letter of indemnity? Or is it a letter of credit? What is it? And the right answer will be mandate. A mandate is a simple instruction given by an account holder to the bank authorizing someone else to operate the account. It ceases automatically on the death, insanity of the person or the insolvency of the account holder. Power of attorney is more formal, notarized, and often used for broader rights such as borrowing or property matters. So in the condition of a bank account, it's called a mandate. Question number 4. In a joint account operated as either or survivor, upon the death of one holder, the surviving holder's right to the balance depends primarily on what are the conditions? Nomination and operational mandate. Option B, the survivorship clause. Option C, legal heirs consent, or the type of account. What is it? And the right answer for this will be option A, nomination and operational mandate. In this condition, under RBI's Joint Account Operation Guidelines, the mandate and nomination guide the bank gives the banker's action. If either or survivor is mentioned, the survivor can operate the account. However, nomination supersedes the survivorship in payment discharge. For example, if a nomination exists in favor of a third party, the survivor can solely claim ownership. Only operational rights can be owned by him. Coming to question number 5. A bank receives a garnishee order for a customer's savings account. The customer's term deposit lien for a loan. Can the bank adjust the deposit amount first? Option A, yes, by exercising the right of set-off. Option B, no, after the order, bank must freeze the funds. Option C, yes, only if the lien is noted before the order. Or D, yes, only with the customer's consent. What will be the answer? In this condition, it is no. After the order, bank must freeze the funds. A garnishee order attaches funds in the banks on the court's direction. Once received, the bank cannot debit or adjust any balance thereafter. The account is frozen to the extent of the order. However, if a lien or set-off is executed before the order, the amount is always protected. So once a garnishee order is issued, no accounts can be closed or adjusted. It can be done before if there is a lien. Question number 6. Banker's lien can be exercised only on what kind of things? Assets held by the bank in fiduciary capacity, the securities belonging to the customer in the same capacity, any security held by the bank, or jointly held securities. What is banker's lien? So the lien is a right to retain goods till the dues are paid. It is a possessory right, but not a right to sell, except in the condition of the pledge. It cannot apply when assets are held as trustee or an agent. So the bank can retain FDs if pledged for loans, but not securities held for the collection. In this case, the answer will be securities belonging to the customer in the same capacity. Question number 7. A check presented for payment lacks the drawer's signature. The bank should pay and recover later, return the check as the signature differs, ask for confirmation from the drawer, or postpone the payment till the signature is verified. A check presented for payment lacks drawer's signature. That is, it does not have a signature. What will be the answer for us? Yes, automatically. Return the check as the signature differs because there is no signature at all. A check without a drawer's valid signature is not valid under the NI Act 1881. So paying such a check means acting without a valid mandate, making the bank liable for unauthorized payment. So always we verify the signature to the core of payment in due course. Coming to question number 8, a check payable to XYZ and Co. is deposited into a personal account of Mr. X. The collecting banker must. What is the duty of the banker in this? Collect check without question, obtain the firm's endorsement in it, obtain the KYC of the firm, or return the check. What should be the answer? The check is drawn in favor of the firm, and the ownership lies with the firm and not with Mr. X individually. So the collecting banker must verify the endorsement to ensure proceeds are credited correctly. Otherwise, it is considered a negligence or losing statutory protection under the section 131 of the NI Act, losing the protection for the banker. So the right answer will be obtain the firm's endorsement. Question number 9. A banker passes a cross check across the counter in cash. A cross check across the counter in cash. Which legal protection is forfeited? A cross check is payable only through an account and not in cash, the first thing. So payment across the counter violates the crossing instruction, making it not a payment in due course. So hence, statutory protection under Section 128 of the NI Act is lost. So the right answer will be option B, Section 128 of the NI Act. We can take an example. If a check is cross-account paying in cash makes a bank liable for the true owner. Starting off with question number 10. If an image in CTS is unclear, what should the paying bank do? Honor based on the amount in the words. Return the check with reasons image not clear. Seek clarification from the collecting bank, or credit provisionally and reverse them later. In check truncation system, the CTS, checks are cleared based on the scanned images. So RBI CTS guidelines mandate clear MICR and signature fields for the validation. If the image quality is poor, payment cannot be confirmed and it is to be returned. So the right answer will be return the check with reasons image is not clear. Coming to question number 11. A bank allows withdrawal against uncleared checks, which later bounce. The bank may recover funds by exercising which of these powers? A bank allows withdrawal against uncleared checks, which later bounce. So the bank may recover funds by exercising which of these options? A banker's lien, a right to set off, a right of appropriation, or the right of indemnity. Which of these options is the right one? The right of set off allows the banks to adjust credit in one account to recover dues from the other account in the same customer's name and capacity. So for example, if a check is dishonored but withdrawal was allowed, the bank may debit another account to recover the amount. This protects the bank from its operational exposure or the operational risk. Coming to question number 12. Under RBI's key KYC master direction, an account opened through offline Aadhaar verification is characterized as what kind of account? Is it a full KYC account? Or is it a simplified due diligence account, a small account, or a medium risk account? What will be the answer for this? In the case of offline Aadhaar verification, that's a QR based, is done and a non-biometric and hence characterized as a simplified due diligence accounts. These accounts are low risk but require periodic KYC updates. Till full account KYC is done, that is biometrically or physical documents, it only allows limited transactions. So the right answer will be SDD account. Coming to question number 13. STRs under the PMLA must be filed with whom? Enforcement Directorate, the RBI, the Financial Intelligence Unit India, FIUIND, or the Ministry of Finance. Under Section 12 of the PMLA Act 2002, all reporting entities must report STRs to the FIUIND. STRs monitor unusual or potentially illicit transactions. So non-compliance leads to severe penalties. So STRs are to be reported to the FIUIND. In a partnership account, a partner dies. The bank must stop payment of checks signed by him because of what of these reasons? A. Partnership dissolves automatically. B. The mandate ceases upon death. C. Nominee takes charge. Or D. The legal heir's consent is required. Which one is the answer? Whenever in a partnership, a partner signing authority or a mandate ceases on death, any checks signed by the deceased must be returned once the bank is notified. So the answer will be mandate ceases upon death. Continuation of business depends on the provisions in the partnership deed also. So automatically, whenever there's a death of a partner in the partnership, the mandate ceases upon the death of the partner, as and when informed to the bank. Question number 15. Bank's liability for loss of contents in a locker arises when locker is jointly operated, negligence of the bank is proved, fire or flood occurs, or the customer delays the rent payment. When does a bank's liability for loss of contents in a locker arise? In this case, negligence of the bank is proved because banks are not insurers of locker contents but have a duty to care. As per Supreme Court of India, liability arises when a negligence or unauthorized access is proven in that condition. And RBI's 2022 guidelines make it mandatory for the banks to have a compensation clause also in this condition whenever there is a negligence of the bank is proved. Question number 16. A customer instructs the bank not to present his check, but is prepared and dishonored. The bank is liable for what of these kinds? Breach of mandate, payment in due course, defamation, or none of the above. A customer instructs the bank not to present his check, but it's presented and dishonored. So what will be the answer? The right answer will be breach of mandate. That is, stop payment is a revocation of the customer's authority. Presenting or paying despite this is a breach of mandate. So the dishonor may not be bank's fault financially, but it is operationally its negligence. So the right answer is breach of mandate, option A. Question number 17. If a depositor dies before interest credit, what does a bank do? Stop the interest immediately, accrue interest till date of death and pay nominee, forfeit the accrued interest, or pay only the principal. What will be the right answer? In this case, the right answer will be accrue the interest till date of death and pay the nominee. Wherein interest accrues till the date of death and is payable to the nominee or the legal heirs. Post death, any balance held till settlement earns savings rate interest. The bank must ensure accurate computation in this condition. Question number 18. Which of the following is not considered a deposit under the BR Act? Is it the fixed deposit? Is it the demand deposit? Is it a share capital or the recurring deposit? It's very easy because you don't have the words deposit in the answer itself. So automatically the answer is share capital. As per section 5B of the BR Act, deposits are repayable liabilities, wherein share capital is an ownership and not a liability, hence not a deposit. Deposits impact the CRR or the SLR for the bank. Share capital forms part of the Tier 1 capital. Question number 19. Under FEMA, resident Indians may hold foreign currency account abroad. How? Is it freely without limit? With RBI permission? Through LRS only? Or only for education abroad? If a resident Indian wants to hold a foreign currency account, what should he do? Or how can he do? It's with the RBI's permission. FEMA permits holding foreign accounts abroad only with general or specific RBI approval. For example, in the condition of employment abroad, inheritance, or as the LRS, limited remittance scheme, within its own limits. Unauthorized holding invite penalties in this condition. Question number 20. A minor's saving account has grown significantly. The bank cannot allow overdraft because of what reasons? The minor lacks the contractual capacity. The minor's guardian is responsible. RBI prohibits overdrafts, or does it violate the AML rules. What will be the answer? It is option A. The minor lacks contractual capacity. Under Section 11 of India's Contract Act, minors lack the capacity to contract. So debt crediting facilities are void in their accounts. And deposits, however, are always valid as they don't create liabilities for the minor. Whenever there is a liability for the minor, they can't go into a contract. So now we are coming into a case study. We will be having a case study of 5 questions. That is from question number 21 to 25. I have not numbered it. Let's go through it. A new customer, Mr. Arjun Kumar, visits your bank to open a current account for a small manufacturing business. He submits his Aadhaar, that is our offline XML file, and PAN as proof of identity and address. The account is opened under simplified due diligence, that is SDD. After 3 months, he begins receiving large inward remittances from unknown entities abroad and quickly transfers those funds to different local accounts within 24 hours. I think you are understanding the concept. A new customer, Mr. Arjun Kumar, visits your bank to open a current account for a small manufacturing unit. He submits its Aadhaar, which is an offline XML file, and PAN as proof of identity and address. The account is opened under SDD. After 3 months, he begins receiving large inward remittances from unknown entities abroad and quickly transfers them to funds to different local accounts within 24 hours. So what type of KYC verification has been performed for Mr. Arjun Kumar's account? It is available in the question itself. It is simplified due diligence. Coming to question number 2. The branch observes frequent large value transactions inconsistent with the customer's profile. The current compliance action is to what? Ignore unless customer is questioned, close the account, file STR with FIO-IND, or ask the customer for a return explanation. What will be the right answer? Under Section 12 of the PMLA Act 2002, every bank as a reporting entity must promptly file a STR to the FIO-IND. Suspicious patterns include frequent large value credits from unrelated parties, a rapid transfer of funds, that is called layering, and unusual foreign inward remittances. Do not alert the customer in this case, knowing as a tipping off which is prohibited under the AML law. So the branch's role is to escalate it to the principal officer who files STR electronically through FIN net portal. And the right answer will be option C, file suspicious transaction report with the FIO-IND. Who in the bank is responsible for reporting such suspicious activity to the FIO-IND? Is it the branch manager, the chief executive officer, the principal officer, or the customer relationship manager? We have discussed the same thing in the previous question also. So it is a principal officer who is responsible for that, for receiving alerts from branches, assessing and validating them, and filing the electronic reports to FIO-IND within the prescribed timeline. Question number 4. To upgrade this account to full KYC, which verification method is mandatory? A physical PAN verification, biometric Aadhaar authentication, copy of GST registration, or option D, letter of introduction from another bank? And the right answer will be biometric Aadhaar authentication. Only biometric Aadhaar based eKYC or face-to-face verification by the authorized bank officer qualifies as full KYC. PAN alone does not establish identity verification under KYC norms. Once upgraded, earlier limits of 1 lakh, 10,000, 50,000 no longer applies. So RBI's RBI mandates re-KYC every 2 years for high-risk customers 8 years for medium risk customers and 10 years for low risk customers. So it is biometric Aadhaar authentication. Coming to the next question, if the branch fails, or the last question of the case study, if the branch fails to report STR activity, that is a suspicious activity, which act is violated? The Banking Regulation Act, the PMLA, the RBI Act, or the IT Act? If the bank fails, it is the PMLA Act. Section 13 of the PMLA empowers the FIO and RBI to penalize the banks for non-reporting or late reporting of the suspicious activity. So penalties include monetary fines and regulatory warnings also. Non-compliance also violates the RBI's master direction of KYC, AML, and CFT, making it a dual breach, that is from FIU and also from RBI. Coming to the next question, let's number it as 21, but it's 26 because we have also completed 5 case study questions. So question number 21, when a bank dishonors a check presented after the drawer's death, it acts as per the customer's instruction, B, in good faith, C, without negligence, or D, without the mandate. What is the answer? When a bank honors a check presented after the drawer's death. In this condition, it's without mandate. The mandate ceases upon the death of the drawer. The bank must stop operation once aware of the death of the customer. If it still honors the check, payment is unauthorized and no protection is given under Section 85 of the NI Act. But once it is informed to the bank, it's the bank's responsibility. If it is not informed, it doesn't. Question number 22. A bank must maintain records of all transactions for a minimum period of how many years? 5, 10, 7, or 8? And the right answer will be 10 years. As per PMLA rules, record retention period is 10 years from the date of transaction or account closure, whichever is later. So this ensures proper traceability of the AML or CFT investigations. Question number 23. When a check is paid through clearing, the paying bank acts as what? When a check is paid through clearing, acts as a holder in due course, acts as holder for value, acts as paying banker, or acts as collecting banker? What will be the right answer? When a check is paid through clearing. In this case, the bank is a paying banker. The bank paying the check is always called the paying banker and must ensure genuineness of signature and account also has a sufficient balance. So protection under Section 85 of the NI Act applies when the payment is made in due course. Question 24. When a customer deposits a check for collection, the bank becomes a bailee, a trustee, option C, the agent, or option D, holder in due course. When a customer deposits a check for collection. So what is the work of a bank, or what does a bank do? It acts as an agent for the customer. The collecting bank acts as an agent for the customer until the check is realized. Upon realization of the check, the relationship converts to debtor and creditor. That is, the banker relationship changes to debtor and creditor. Question number 25. Under Section 131 of the NI Act, a collecting banker gets statutory protection in what of these conditions? When they act negligently, when they collect cross-check for the true owner, when they collect bearer check, or collects without endorsement. Collects a check without endorsement. When does a banker get the statutory protection? And the right answer will be option B. Collects cross-check for true owners. Section 131 protects a collecting banker who collects a cross-check in good faith and without negligence. If the bank ignores suspicious signs like unusual endorsement, it loses the protection. So collect cross-check for true owners is the right answer. Question number 26. A check marked not negotiable means it can be transferred, it cannot be endorsed, transferee does not get better title than transferor, or it must be presented in person. A check is marked not negotiable. And the right answer will be option C. Transferee does not get better title than the transferor. Not negotiable does not stop transfer, but removes the protection of better title under the NI Act Section 130. Hence, the transferee gets only the title of the transfer. A holder in due course is one who holds a check for collection, obtains a check after dishonor, holds a check for value and in good faith before maturity, or acts as an agent of the bank. As per Section 19 of the NI Act, holder in due course enjoys stronger rights even after prior defects in the title. He must obtain the instrument for value in good faith before it becomes overdue. So the right answer will be holds a check for good faith and check for value and good faith before maturity. That is option C. Coming to question number 28. Under RBI guidelines, nomination in deposit account ensures what of these kinds? Nominee becomes an owner, nominee receives funds as trustee or legal aid, nominee shares equally with heirs, or the nominee inherits the property. This is one of the main or the most important point that are to be understood by the bankers. In this, the answer will be option B. Nominee receives funds as trustee of the legal heirs. Nominee acts as a trustee and not as an heir. So the legal ownership passes to the heirs under succession law. The nominee merely receives the funds for onward distribution. Nominee does not inherit the property or the fund. So he should, or under the succession law, the nominee should forward the funds to the legal heirs. Coming to question number 29. In case of joint mandate or joint accounts with either or survivor mandate, on death of one holder, the balance is payable to whom? The legal heirs, the nominee, the surviving holder, or the executor of the deceased. What will be the right answer? It is an either or survivor account. It is to be given to the surviving holder. The either or survivor clause always allows payment to the survivor without reference to the legal heirs. However, this does not override the succession law if heirs challenge the settlement in that case. Coming to question number 30. Under the Limitation Act, the limitation period for filing a suit on a dishonored check is what time? If there is a check that has been dishonored, what is the time period given for filing a suit? The right answer will be 3 years. The Limitation Act prescribes a 3 years limitation for suits on bills, notes, and checks from the date of dishonor. So after expiry, the debt becomes time-barred, though it may remain morally valid. So in this condition, you can file a suit on a dishonored check till the period of 3 years from the date of dishonor. Coming to question number 31. Under the Banking Regulation Act, the term banking means lending of money to customers, accepting securities for safekeeping, accepting deposits repayable on demand or otherwise for lending or investment, or discounting of bills only? The right answer will be C, accepting deposits repayable on demand or otherwise for lending and or investment. Defined under Section 5B of the BR Act, banking means accepting deposits from public, repayable on demand or otherwise, for the purpose of lending or investment. This definition also differentiates banks from NBFCs and the mutual funds. Question number 32. The right of lien enables a banker to what of the retain goods or securities till debt is paid, sell the securities without notice, adjust accounts of other branches, or seize the customer's property. What does right of lien enable a banker? Banker's general lien, that is that which comes under Section 171 of the Indian Contract Act, allows retaining possession of goods or securities until the dues are clear. So the right answer will be option A, retain goods or securities till debt is paid. It is a possessory right, but not a right of ownership or sale. Right of lien is a possessory right, but not a right of ownership or sale. Question number 33. When a bank receives a garnishee order, it must freeze all accounts of the customer, close customers' accounts, allow withdrawals up to minimum balance, or stop only term deposits. Whenever garnishee order is issued, it is issued under CPC Section 60, which directs the banks to attach funds of the judgment debtor. Upon receipt of this, the bank must freeze all the accounts up to the amount specified in the garnishee order. Violation may make the bank personally liable for that account. So the bank should freeze all accounts of the customer to the amount mentioned in the garnishee order or the GO. The relationship between a banker and customer in the case of safe custody article is it debtor or creditor, bailer and bailee, principal and agent, or a trustee and beneficiary? This is in the case of safe custody of article. The right answer will be bailer and bailee. When variables are given for safe custody, the bank acts as bailee and the customer as the bailer. The bank owes a duty of reasonable care and not guarantee. So in this condition, the answer will be bailer and bailee. In case of a joint Hindu family account, there is a HUF account, the Karta can operate the account independently, authorize any outsider to operate the account, transfer funds without consent of co-partners, or not open account without RBI approval. So who is a Karta? Karta is the head of a family and a legal representative of the HUF. He can open and operate accounts on behalf of the HUF. So the right answer is operate the account independently. However, his authority is restricted to the family business transactions only. His authority is restricted only to the family business transactions. So in case of a joint Hindu family, a Karta can operate account independently. When a check is post-dated and presented before its date, the banker should pay on presentation, hold till the due date, return with a reason that it's a post-dated check, or accept under collection. Should a banker collect it? Should he return it? Or should he pay it? Or hold till the due date? What is it? A post-dated check is not payable until the date mentioned. So payment before due date is unauthorized. Once the date arrives, it becomes a valid instrument. But in this case, the bank must return the check since it is a post-dated check. Question number 37. Under Section 138 of the NI Act, a check is deemed dishonored for insufficiency of funds. in what of these conditions? Return unpaid due to account closure, return unpaid for signature mismatch, return unpaid for the technical error, or return due to the stale date. So, a check is deemed dishonored for insufficiency of fund in which of these conditions? Section 138 covers dishonor of insufficient funds or the account closure, which is treated equivalently. If you don't have an account, how can you present a check? So automatically means that you don't have money in that account. So other reasons like signature defaults are not covered under 138, and the complaint must be filed within 30 days of receiving the return memo. So the right answer will be option A, that is return unpaid due to account closure. Question number 38. When the drawer's signature on a check differs from the specimen, the banker should make the payment, return with signature differs, hold check till clarification, or pass under the manager's discretion. The bank must ensure signature before honoring any checks. Mismatch implies potential forgery. So the safest action is to return the check unpaid, that it protects the bank from liability for wrongful payments. So the right answer is return with signature differs. Question number 39. When an account shows inoperative status for over 2 years, the bank must close it automatically, transfer it to RBI, review and report as inoperative under the RBI guidelines, or charge penalty. When an account is inoperative for over 2 years. In this condition, as per the RBI's Master Circular on Customer Service, an account is inoperative if there is no transactions for the previous 2 years. Bank must monitor such accounts, prevent misuse, and report in the CBS. Dormant status does not extinguish ownership rights. So this is to be checked upon. And the right answer will be review and report as inoperative under the RBI guidelines. Question number 40. When a check is crossed as account pay only, it means pay cash to pay through clearing only, credit must go only to pay's account, or transferable by endorsement. When it's crossed as account pay crossing directs the collecting banker to credit only the named payee's account, ensuring secure payment. So credit must go only to the payee's account. That is option C. It restricts negotiation also and prevents misuse by intermediaries. That is, it is not transferable, or it cannot be encashed at the counter. Coming to question number, this is 46. We are coming into case study again. We have 5 case studies in this also. I hope you are liking this session. Please do like, share, and subscribe the channel Brilliant Bankers, so it will give me more motivation for new videos like this. Your branch receives a complaint from Miss Priya Mehta that a check for 2,50,000 rupees drawn in favor of Measures ABC Traders was fraudulently altered and encashed. The check has been crossed as account payee only, but the collecting bank credited it to another account due to a data entry error. Both banks are now disputing the liability. So what really happened? Ms. Priya Mehta had a check for rupees 2,50,000 that was drawn in the favor of Measures ABC Traders, which was fraudulently altered and encashed. The check was crossed as account payee only, but the collecting bank credited it to another account due to a data entry error. Now, 2 banks are now disputing the liability. So, who is primarily liable for wrongful credit in this case? Is it the paying banker, the collecting banker, the customer, or the RBI? Is it the paying banker, the collecting banker, the customer, or RBI. In any case, RBI and customer doesn't come. So who is it? A or B? Is it the paying or the collecting banker? In this condition, the collecting banker must ensure the proceeds of a cross account payee only checks are credited only to named payee's account. So miscrediting constitutes negligence, stripping of the protection from they are given from section 131 of the Negotiable Instrument Act. So the paying banker is not at fault if the check is genuine and presented correctly. Automatically, the correct answer will be collecting banker is primarily liable for the wrongful credit in this case. Coming to the second case study question, under which provision does a collecting banker lose statutory protection? Under which act? As discussed earlier in the previous question itself, a collecting banker loses statutory protection under section 131 of the NI Act. Coming to question number, and the same is the condition with paying banker. It is section 85. What precaution could have prevented this fraud? Is it the signature verification? Is it the manual entry system? Is it system validation for account pay only checks? Or allowing withdrawal after 7 days? As per the modern CTS, there is a check truncation system mandates system validation for crossing and paying matching. So manual oversight should verify the drawer, payer, and the MICR data before crediting. Internal controls, wherein the maker and checker concept, also the dual verification for non-routine items are also to be done. So system validation for account payee only checks are to be considered as per the latest CTS rules. Coming to question number 4. What is the duty of the paying banker when such check is presented through clearing? Verify endorsement and cross-check the account, return the check unpaid, hold for the customer's confirmation, or rely solely on the collecting bank's data. Here comes the paying bank's primary duty to verify the signature authenticity, ensure the check is not altered, and check the crossing type and endorsement validity also. Paying banker is not required to verify the payee's account number in the collecting bank, but must ensure the instrument appears regular. So the right answer will be verify the endorsement and cross-check the account. And for the last question of the day, what compensation principle applies when a negligence of collecting bank is proven? Is it a mutual adjustment between branches? Is it liability limited to check value plus interest? Is it compensation from customer or no compensation if check was small? In this condition, when negligence is proven, full restitution applies. That is check value first the applicable interest. The Supreme Court Locker and check negligence case of 2021 reaffirmed that customers must be compensated for operational lapses by the bank. So RBI's 2022 Customer Protection Circular also mandates transparent compensation for errors attributable by the bank to the customer. So the right answer will be liability limited to check value and interest. So that's it for the day. This is Nishant signing off from Brilliant Bankers. Do like, share and subscribe our channel. Also to share this channel to your friends who are pursuing JAIIB and CIB. Jai Hind.